Hey everyone, welcome back to Corporate Decoder, the place where we try to uncover if Hilton's latest financial report is a blockbuster hit or a room service disaster. Let's dive into Hilton's second quarter report for 2025 with a look at their financial health. This report gives us a peek behind the curtain of Hilton's operations for the 3 and 6 months ending June 30th, 2025, comparing it to last year. First up, the balance sheet as of June 30th, 2025 shows their assets and what they owe. Remember, these are in millions of dollars, so a big number is actually much bigger. Their total assets are around $15.9 billion, which is a slight dip from the $16.1 million. That's a significant amount of cash drawn down. On the other side of the balance sheet, their liabilities and equity tell a story too. They owe roughly $20.4 billion, which is up slightly from last year. Interestingly, their current debt maturities fell from over $500 million to just $35 million this year. That feels like they paid off some short-term debts. Looking at their equity, they have a substantial deficit. Their accumulated deficit is over $2 billion now. This isn't always a bad sign for growing companies, but it's worth keeping an eye on. What's more concerning is the treasury stock, which is basically shares they bought back. This jumped from about $11.2 billion to $12.9 billion. That's a big chunk of money spent on buying back their own stock. Now let's look at how they made money and spent it in the income statement. For the second quarter of 2025, their total revenues were about $3.1 billion, up from $2.9 billion last year. That's a healthy increase. A big driver of this revenue is franchise and licensing fees, which went up over 8% to $745 million. This shows their core franchising business is strong. However, their ownership revenues, which come from hotels they actually own or lease, went down slightly by about 1.5% to $332 million. This could mean their own properties aren't performing as strongly as their franchised ones, or that currency exchange rates are playing a role. On the expense side, total expenses increased to $23 billion from $2.2 billion last year. While revenues grew, so did expenses. This led to an operating income of $778 million for the quarter, up from $725 million last year. So, despite rising costs, they managed to increase their profit from actual operations in the business. Ultimately, their net income attributable to Hilton stockholders for the quarter was $440 million last year. This is a positive sign showing growth in their bottom line. And their diluted earnings per share went from $1.67 to $1.84, a good bump for shareholders. The statement of comprehensive income shows other income and losses beyond regular operations. They had about $506 million in comprehensive income, seems to be driven by currency translation adjustments, a good chunk of it. Now let's talk cash flow for the first 6 months of the year. This is where we see what cash is actually coming in and going out. Their net cash provided by operating activities was $1.1 billion, which is a solid increase from $767 million last year. More cash from the day-to-day business is always a good sign. However, their investing activities show a significant decrease in spending. They spent only $86 million on investing activities this year compared to $318 million last year. Looking closer, last year included over $230 million for acquisitions like the Graduate brand and the Nomad brand. So this year's lower spending here isn't necessarily a bad thing. It just means fewer big acquisitions happened in this period. Financing activities are where things get really interesting. They used nearly $2 billion in financing activities this year compared to just about $500 million last year. A huge part of that is their stock repurchases, which were a whopping $1.6 billion this period, alone, up from $1.4 billion last year. This shows a strong commitment to returning cash to shareholders, which can boost stock prices. They also repaid debt and had some borrowings under their credit facility. Let's touch on their debt. As of June 30th, 2025, the total long-term debt is about $10.9 billion. This is roughly in line with last year's debt level. They did pay off their 537.5 senior notes due in 2025, which is good, but they also issued new debt in July 2025, the 5.750 weekend senior notes due 23rd, y'all. The 5.75 0.3% senior notes due 23rd, which is good, but they also issued new debt in July 2025, the 5.750% senior notes due 2033. When they talk about fair value measurements, they are essentially saying how much their financial assets and liabilities are worth in the market for their long-term debt. They report a carrying value and a fair value. As of June 30th, 2025, their long-term debt carrying value was about $10.9 billion. The fair value, however, is broken down by hierarchy levels. Level 1 uses observable market prices for identical assets. Level 2 uses observable inputs other than prices quoted for identical assets. Level 3 uses observable inputs for their debt. About $73 billion is considered level 1 fair value, which means it's based on readily available market prices. For a significant portion, around $3.4 billion, is level 3. This means its fair value is based on their own internal estimates, because market data isn't readily available market prices. But a significant portion, around $3.4 billion, is level 3. This means it's fared on readily available market prices, but a significant portion, around $3.4 billion, is level 3. This means it's fared on readily available market prices. They mentioned share-based compensation, which is basically giving employees stock and options as part of their pay. They recognized over $90 million in this compensation for the first 6 months of the year. This is a cost, but it's also a way to incentivize employees to perform well and think like owners. Looking at earnings per share, their diluted earnings per share for the first 6 months of 2025 was $3.07, up from $2.71 last year. This demonstrates a positive trend for shareholder value. This section details changes in equity and losses. What's interesting here is the significant increase in treasury stock in the second quarter alone. They repurchased over 3 million shares for about $762 million. This aggressive buyback program is a major use of their cash. Hilton operates in two main segments: management and franchise and ownership. The management and franchise segment, which is their fee-based business, is clearly where the money is. Segment adjusted EBITDA for this part was nearly $1 billion for the quarter. The ownership segment, however, is much smaller, with an adjusted EBITDA of only $57 million for the quarter. This confirms their strategy to focus on asset-light franchising rather than direct ownership, which is generally less risky and capital intensive. Their franchise and licensing fees are the stars here, growing robustly. They cited increases from co-branded credit card arrangements and their timeshare business, leading to higher licensing fees. This business segment shows strong growth, showing their brand power and franchise model is working well. Their ownership segment revenues are actually declining slightly, which, as noted earlier, could be due to economic factors, currency fluctuations, hotels leaving their system, or renovations. Overall, adjusted EBITDA was about $1.8 billion for the first 6 months of the year, again showing strong operational performance beyond just net income. Management's discussion and analysis highlights their focus on global expansion and growth through their development pipeline. They are adding hotels at a good pace, with over 400 new openings in the first half of the year. Their net unit growth was 7.5% year over year. That's solid growth in a competitive industry. They define comparable hotels those in operation for at least a year and not undergoing major changes. About 6,400 of their 8,700 hotels fit this definition. What's interesting is the number of non-comparable hotels, which is over 1,800. This includes hotels they added recently or those that have had significant changes. Looking at hotel performance indicators, occupancy across their system dipped slightly by about 0.5% for the quarter to 74.4%. But average daily rates, or ADR, actually inched up by 0.2%. This resulted in revenue per available room, which is RevPAR, essentially a key industry metric, to dip slightly by 0.5%, as higher rates couldn't offset lower occupancy. This was especially true in the US, where RevPAR was down 1.5%. Europe showed a stronger performance, with RevPAR up 2%, driven by increased business and leisure travel. The Middle East and Africa region saw a significant 10.3% jump in RevPAR, partly due to increased leisure travel. Asia Pacific also saw a slight RevPAR increase. The controls and procedures section confirms that management, led by the CEO and CFO, have evaluated their internal controls and found them effective. This is standard but good to see. No material changes to their previously disclosed risk factors. This means the same old risks like economic downturns, competition, and geopolitical events are still on their radar. Now a quick look at share repurchases. In the table here we see they bought back over 3.2 million shares in the second quarter. This aggressive buyback program is a key strategy to boost shareholder value. Ixthi now for my take on Hilton's report. Hilton is clearly doubling down on its asset-light franchise model, which is smart. Their management and franchise segment is a cash cow, driving solid revenue and profit growth. The continued expansion of their hotel network globally and the strength in their loyalty program Hilton Honors are definitely positives. However, there are a few areas to watch. The significant decrease in their cash position is notable, and while they have access to credit lines, it's something to monitor. The large accumulated deficit and the substantial increase in treasury stock suggest they are heavily prioritizing shareholder returns, which is great for investors in the short term but could limit future investment opportunities if degree of uncertainty. The slight dip in RevPAR for the quarter, particularly in the US, is a concern. While the international markets, especially Europe and MEA, are performing well, the US market, which is their largest, is showing signs of slowing demand, which could impact future earnings if it continues. Overall, Hilton appears to be navigating a complex economic landscape effectively with a strong core business, but they aren't without their risks, especially regarding cash management and US market performance. What do you think about Hilton's latest earnings? Are you bullish or bearish given these numbers? Let me know in the comments below. If you found this breakdown useful, please hit that like button and subscribe for more corporate dissections. And don't forget to join our Discord community linked in the description for even more insights and discussions. Thanks for watching, and I'll see you in the next one.